Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Canada's inflation rate ticked higher last month. Data from StatsCan shows the annual rate of inflation rose to 2.8% in April, reaching the highest level since May of 2024. StatsCan says higher energy prices fueled by the conflict in the Middle East drove inflation higher, with gasoline prices surging 29% compared to the year before. There was an 11% price drop for travel tours and a slowdown in rent inflation across the country. Shares of Agnico Eagle Mines moving lower today. The miner going ahead with a large gold mine in Canada's far north. Agnico has given the green light to the Hope Bay mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The project has been hailed by the federal government as an anchor for economic development in the Arctic. Shares of Sherritt International getting a lift. The company says it's no longer proceeding with the dissolution of its Cuban joint ventures, including its split from Cuba's General Nickel Company. It will instead maintain the suspension of its direct participation in activities. Sherritt says it's evaluating ways to mitigate the impact of American sanctions. It cautioned that any transaction or restructuring remains preliminary and may not be completed. Here's where we stand on the markets right now. The TSX moved down today 64 points on the day, or 0.2%. Let's move south of the border. And a streak of red on the American markets, with the S&P 500 down almost 0.5%. The Dow Jones down about 0.5%, 231-point drop on the day. The Nasdaq down 0.6%, 158 points down so far on the day. A market pullback could be around the corner due to factors like the higher oil prices and rising bond yields. But my next guest says long-term growth drivers make this a buying opportunity. Joining us now is John Bay. He's Chief Investment Officer at NEI Investments. Thanks for joining us today.
Thank you very much for having me.
Let's talk about inflation, bond yields. Do you think that earnings are going to be affected down the road now because, for example, oil prices have been high for so long now?
Yeah, that's the great question. I mean, we talked about CPI rate on your headlines. In Canada, it came in at 1.5% on a core basis, which is interesting because, again, in Canada, they're running much weaker than we saw in the U.S. U.S. latest CPI and PPI has been very, very hot. As you talk about in terms of earnings, the first quarter earnings session for the S&P 500 was very strong. We came in expecting about 13% earnings growth. We're looking at, it came in at 27%. Of course, we'll talk about NVIDIA in a second. But going forward, that's what we've been looking for. We've been reading the transcripts and looking to see what CEOs have to say. Mm-hmm. And so far, a month into, actually, we're now day 81. But as of the earnings calls, the CEOs haven't been guiding earnings downwards. They, in fact, actually been guiding earnings upwards, which is incredible. And the strength that we're seeing is not just in the tech sector. We're seeing 10 out of the 11 sectors in the S&P 500 going higher. Of course, in Canada, the commodities are benefiting from that. So far, so good. We'll keep an eye on earnings going forward. The longer this conflict stays, of course, the higher the downward pressure. And now we're getting to critical levels on oil inventories and physical prices.
Let's talk about the bond yields in the U.S., which are moving higher. Do you expect Canada to follow?
Bond yields, just pause on that just for a second because we're hitting such critical points. The U.S. is at through 5% on the 30-year, which is a very important psychological level. The 10 years through 4.5%, which is also a really important psychological level. So, historically, investors have, once the bond yields pierce those levels, the equity markets have sold off. Mm-hmm. But now we're so myopically focused on earnings that you talked about, the equity investors have ignored the bond yields. But we're getting to levels where they actually can't ignore them for much longer, and we expect those bond yields to put downward pressure on the equity valuations and going forward. In terms of Canadian bond levels, which is your original question, I think it's we've also seen the upward pressure due to oil prices. But if you think about the global bond opportunity, the U.S. 30-year highest since 2007, UK the highest since 1998, Japan the highest on the 30-year bill since 1996, we actually see a tremendous opportunity for bond investors globally. Canada, being less than 5% of global equity markets, is well known by Canadian investors. What's less known is that Canadian bond markets are very similar position, less than 5% of the global bonds. So we think a lot of Canadians are actually underweight global bonds, and at these levels, we think there's a lot of attractive opportunity.
I was going to say, you think if a market pulls back, which, as we said, hasn't really pulled back the way you thought it would right now with the yields going the way they are, you think that's a buying opportunity? Tell me a bit more.
Yeah, I think that the conditions are ripe for a pullback. We're seeing bond yields, as we said, through those psychologically important levels. We're seeing oil prices continue to maintain higher than $100 a barrel. We're also seeing, positioning, very bullish positioning. We saw a Bank of America fund manager survey come out this morning saying that the drawdown in cash has been one of the sharpest ever, moving that into equity. So investors are not positioned for a pullback, and that creates vulnerability, and so we wouldn't be surprised to see that. But what we are seeing is we're seeing a lot of these mega trends. The AI build-out is tremendous. The infrastructure build-out, the grid build-out, again, the deglobalization that's creating supply chain redundancy. All of that is positive for the economy as well as for earnings going forward. NVIDIA
reports tomorrow, one of the last ones to report. What do you expect? It really, in the past, we know at the end of last year, they could hit it out of the park and investors were not that impressed. What do you expect this time around?
Yeah, it's probably the most important earnings of the tech that we're watching for sure. We saw blowout earnings from Alphabet and Amazon and Google. And again, a market is now positioned. I think the latest number I saw was 80% year over year, which is absolutely tremendous. I think one of the things that we're going to look for clarity on is Jensen Huang recently talked about the $1 trillion opportunity, whereas he sees visibility on revenues out of $1 trillion over the next 2 to 3 years. I think that if he confirms some of those numbers, to your point, will we see a blowout, top out earnings? Probably not. But again, the market will be very settled by that type of news. And again, right now, the global chip story is is probably one of the most biggest position in institutional investors. We saw that.
Do you think that'll continue for the rest of the year?
So, I think that there is a rotation opportunity. We're starting to see that in the Canadian marketplace and some of the tech names, but we're also seeing before the war happened, we saw money rotating out of the U.S., international into Canada and emerging markets, and that took a bit of a pause with the war in Iran. We think that later on in the year, I think there's an opportunity to go back into that trade for sure.
We have two Canadian tech stocks moving in opposite directions. Celestica is pledging, Constellation Software is gaining a little bit again. What does that tell tech investors here?
Yeah, it's super interesting. I like to talk about it as the tale of two cities, the haves and the haves not. Obviously, Celestica has been a beneficiary of the AI hyperscaler build out. Their stock price has gone from $100 to $400, pulled back recently. Again, they've been a beneficiary of the AI build out. Constellation Software has been vulnerable to the AI build out. They've gone from $5,000 a share to recently $2,500 and now rebounding. Again, the earnings, no real data points that I see, so I think this is just a rotation within the marketplace. But, Constellation came out with earnings last week. They said a couple of interesting things from my perspective. One, free cash flow increased to $750 million. That is a rarity now as hyperscalers start to use their free cash flow and use that to build out CapEx. But the other thing they said was that the AI is not a vulnerability to their software franchise. It's actually an opportunity for them. So whether or not that will take some time to play out. And so if they can take that AI vulnerability to an actual beneficiary, then we'll see. But again, as a macro strategist, we can't comment on
investors might need to see the proof of that coming down the line. All right, I do have to leave it there. Thanks for coming in.
No, thank you for having me.
All right, we are going to leave the conversation there. Coming up next, we have this. The likely path ahead for the Bank of Canada after the inflation rate, which came out today. We'll get into the details in just a moment. Inflation in April was lower than expected. Prices rose at the highest annual rate in 2 years, mostly driven by higher gas prices. But setting aside energy prices, inflation of other goods and services slowed down. For more on what it could mean for the Bank of Canada and the policy rate, let's go to Randall Bartlett. He's Deputy Chief Economist at Desjardins. Thanks for joining us today.
Well, thanks so much for having me.
So, what would you think is the bigger story here? The total CPI driven higher by energy, which we expected, or non-energy inflation that's cooling?
Yeah, I think the real surprise in the data today was how much underlying inflation actually cooled and how broad-based the cooling and underlying inflation was. Everybody expected that prices were going to accelerate in the month. We knew that it was going to be driven by higher energy prices and gasoline in particular. But I think the real surprise was just how soft the underlying inflation numbers were and how broad-based that weakness was.
Any indication of what kept food prices lower this time around?
Well, I think part of it is a base effect story. So I think there's some of that under the hood, but also, some of the headwinds that we saw just a year ago with all of the tariff activity happening, the weakness in the Canadian dollar at the time, that sort of thing. There were a lot of factors that I think pushed food prices higher and kind of kept them higher on a year-over-year basis that have really started to come out of the wash a little bit. But even then, food price inflation still at 3.5% is much higher than I think the Bank of Canada and most households are really comfortable with. So there's a lot of I think there's a lot of concern there still on that front, but certainly better news than many had expected.
Yeah, there is concern, of course, that some of the energy prices will now bleed into the food prices. They'll go higher again because of transportation costs. What's your thinking on that?
Yeah, we put a note out on this last week, and we think certainly we're going to see that higher energy prices are going to feed into higher underlying prices through transportation, as well as the supply chain disruptions that we're seeing. And we look at food, we're expecting that higher fertilizer prices are also going to make a contribution to higher inflation over the outlook, particularly in the coming quarters, toward the end of this year, beginning of next year. But we think it's going to be relatively modest. We're talking, 2 to 3, 0.4% kind of thing, depending on the category. Overall, it's going to be relatively modest on the core inflation side of things. We're really just expecting to see that the big swings are going to happen with headline inflation because of those energy price moves.
Why do you think we haven't seen the higher energy prices spill into underlying inflation yet?
Well, we think it's still too early. It does take time for this to feed into underlying inflation, not just through higher transportation costs, but also higher input costs, whether those are on the fuel side of things, on the transportation, the manufacturing side of things, fertilizers, depending on what it is. So it does take some time to feed into those into the underlying inflation measures. So it will start to show up, but ultimately, it is something that does take a few months to a couple of quarters to really start to show up in the underlying data.
Okay, let's talk about the Bank of Canada. How do you expect the Bank of Canada to interpret the report released today?
Well, if anything, we think the Bank of Canada probably breathed a sigh of relief when this data came out today. Obviously, there's been some pressure in terms of market pricing and for expectations that the Bank of Canada will hike as much as twice by the end of 2026. But the Bank of Canada very much highlighted in its April NPR that while there is upward pressure from higher energy prices on inflation, there's also a downside risk to the inflation outlook because of the weaker Canadian economy and the upcoming review of the Canada-U.S.-Mexico agreement that's coming to a head on July 1st. So really, there's a sort of two-sided risk the Bank of Canada is contending with, and when it comes to the inflation outlook, that it has to balance. And we think that it's probably going to do that by keeping rates stable through to the end of 2026.
Let's take a look at shelter for a moment, because we have cooling inflation for shelter as well in April. Any specific reason you see feeding into that?
Yeah, it's broadly a good news story, I would say, on the inflation front. When we look at what we're seeing in terms of rents, rent inflation continues to decelerate, still higher than it has been, say, pre-COVID, but certainly coming down, and that's very, very good news. Back to levels we haven't seen since, I believe, 2022. So that's a good news story. And we look at when we look at what's happening with ownership inflation, we're seeing that it's back down to levels we haven't seen since 2013, and that's really because of what we've seen in terms of mortgage interest costs. Mortgage interest costs barely kept itself above water, and is continuing to head south. And so certainly we're seeing that a lot of the drivers of shelter inflation are cooling quickly, and that's a very, very positive story for Canadian households, and ultimately supportive of the Bank of Canada again having a bit of room to stay on the sidelines.
Do you think higher bond yields could derail recovery for housing?
Well, it's entirely possible that we are going to see the mortgage costs are going to tick higher as a result of rising bond yields. The Bank of Canada really has a lot of influence over short-term interest rates, not so much as you move further out the yield curve. And so when we look at, say, 5-year mortgage rates, that's going to be more impacted by 5-year bond yields, which is going to be again influenced by what's happening on global markets more so than shorter-term rates. And so it will have an impact. And rising bond yields are helping to tighten financial conditions in a way that the Bank of Canada doesn't need to at this point. And so the Bank of Canada, again, has more room to sort of stay on the sidelines and not intervene and raise rates to combat inflation as a result of higher, longer-term bond yields, tightening financial conditions, and ultimately providing a bit of a slowing to the Canadian economy.
You mentioned, Randall, that CUSMA, of course, is something you're keeping an eye on. Is there anything else that you do have to keep an eye on, or you think we should be keeping an eye on that will sort of feed into inflation in the near term?
Yeah, well, I think there's an interesting trade-off between what we're seeing in terms of the impact of higher higher energy prices on exports, investment, and national income in Canada. Generally, that's all a positive and sort of a net positive for GDP overall. And the bank showed the same thing in its April NPR. But the longer prices stay elevated, so it's not just inflation, it's the actual price level. Ultimately, that puts a greater constraint on households, particularly at the lower end of the income distribution, and starts to slow consumption growth. And so it really is a double-edged sword when Canada gets hit with an upside energy price shock, where there's some positive impacts, especially in the near term. But the longer that lasts, the greater the weight on consumers and consumption overall. So certainly something to watch going forward.
Randall Bartlett is Deputy Chief Economist at Desjardins. Thanks for your time. Appreciate it.
Oh, my.
When we come back, the court case between Sam Altman and Elon Musk has been decided. We'll tell you what the jury had to say when we come back. So in the end, it was a simple matter of timing. A jury rejected Elon Musk's claims about OpenAI, saying the billionaire waited too long to sue the company. Bloomberg intelligence reporter Matthew Schettenhelm joins us now to talk some more about that. Matthew, this must be a huge relief for Sam Altman. What was at stake here?
Yeah, it's a big deal for OpenAI because the remedies that Musk was seeking in this suit not just are financial, but they went to the company's ability to pursue investors going forward. Musk was seeking over $100 billion in damages. And he was also seeking limitations on how the company could operate going forward. He wanted the company to be bound to pursue the good of humanity, not the investment returns for individual investors. And by prevailing in the case, OpenAI avoids all of that. It can move ahead seeking all the investment it needs to be a successful AI company, including potentially an IPO.
The jury decided it was simply too late to sue, but couldn't that have been decided earlier on? Wouldn't that have been a big red line in the sand, as they say, and then at a certain point it's coming too late?
Yeah, it was sort of a surprise that the judge let the case get this far. She refused a motion to dismiss pretty early on in the case. Then she refused a motion for a summary judgment, including on this statute of limitations question. She said, you know what, both sides have arguments on that, on whether he sued too late. Let's go to trial. Let's let a jury take a look at it. And so that's what she did. And so the jury was taking up both this timing question and the merits question. But as you said, the jury came back just on the timing question with an answer against Musk.
Matthew, can Musk appeal, given that he waited too long to sue, or that was the finding here? Can he appeal at all?
Yes. So he will have an argument that he was not filing outside of the statute of limitations, and maybe that the judge misapplied the law in giving the jury instructions on that issue. So I expect that's exactly the appeal he'll take to the Ninth Circuit Court of Appeals, to say that, in fact, no, he didn't sue too late, and the jury and the court should have reached the merits of his claim, that did OpenAI really steal this charity or not. Someone needs to look at that, he will say, because he didn't sue too late. That will be the case he'll make to this appeals court. I think it's an uphill battle for him. Appeals courts don't like to get into the messy facts. And so it's going to be tough for him to make a legal argument, to say that there's a legal error. This was a 3-year statute of limitations. And I'm not sure there's a lot of uncertainty on the law that will give him a strong chance on appeal.
All right, we will watch. Matthew Schettenhelm is with us today, giving us the latest on that court case. Thanks for that.
My pleasure.
So Ottawa is pushing industry to adopt AI, but some PEI business leaders warn the province's power grid may not be ready to support the added demand. CTV's Maria Saru reports.
Talking trade, technology, and what it takes to grow, Canada's industry minister was in Charlottetown this week. But as the federal government pushes AI adoption, some business leaders worry PEI's power system will struggle to keep up.
We seem to be, on the precipice of an energy crisis right now.
The province's electricity supplier has warned PEI could face shortfalls at peak times and has prepared customers for rotating outages when it reaches maximum capacity. Nationally, Canada's energy regulator says the rapid growth of AI applications is a significant contributor to rising energy demand and requires substantial computing power.
We've got a real opportunity to grow and grow really fast, but we just won't be able to do it if we don't have energy and power.
Most of the island's electricity comes from New Brunswick through 4 subsea cables. 2 are nearing end of life, and the provincial government says replacing them is a high priority. But that will require federal funding, and PEI has applied for preliminary support. When asked about funding for provinces, Canada's AI minister pointed to the National Electricity Strategy launched this week, which aims to double grid capacity by 2050.
There is a huge focus on making sure we've got baseload power and that we've got the energy grid to support the future.
Back on the island, hands went up at another business event when keynote speaker Jane Arnott asked who is already using AI.
AI is here. It is everywhere. It's being used all the time for operational efficiency.
The next hurdle is for island infrastructure to handle more demand. Maria Saru, CTV News, Charlottetown.
Let's take a quick look at the markets before the end of the trading day. They are in the red. TSX down almost 100 points right now, or 0.3%. The S&P 500 down 0.75% right now. The Nasdaq down 248 points. That is almost 1% down on the day. We will bring you the end of day numbers when we come back. Stay tuned. Here are the closing bells for the end of the trading day. At the Nasdaq today, Care Cloud ringing the bell. In New York, it's Bread Financial doing the honors. And for the TSX, Thistle Resources ending the day. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. A day of red for the North American markets, with the TSX Composite down 92 points, or 0.3%. The S&P down 0.7, a 49-point drop on the day, and then the Nasdaq down 220 points, or 0.8%. Let's get to some of the movers in Toronto. The material sector down today about 3% as a whole. So when we look at the movers, you will see what we are seeing here, which is Aya Gold and Silver down 14.5%. That's $3.84 a share to $22.63. America's Gold is also down today. America's Gold dropping double digits as well as part of the material sector drop. It is down 13.3%, or $1.19 to $7.77. Energy Fuels, another one we're watching today. It's down over 12%, or $3.12 a share to $22.25. And Perpetua Resources down double digits as well, 12.5%, $4.84 a share. Silvercore, another one we've kept an eye on. It is down over 9%, taking the share price to $16.91. Let's move to the green. Go Easy, credit lender here, up today 8.7% or 260, recovering a little bit from private credit concerns. It's at $32.59 a share. And then Thomson Reuters, software concerns, AI concerns around this stock. It has been struggling for a while, but today bouncing back 5.4% or $6.18 a share. Constellation Software, also a gainer, 4.5% under those same concerns about software. It moved up $117 today to $27.29. Let's get to movers south of the border. Bloomberg's Avalon Purnell joins us now. Avalon, we saw pet value stock slide last week. Chewy shares down today. The same narrative, I guess, about consumers being stretched.
Absolutely. Chewy was down about 9.1% to end at its lowest level since 2024. And that's partially because the CEO had rather cautious commentary to say earlier today at a JP Morgan conference. Part of that, he said that while he expects Chewy's pet segment to continue to be resilient, the company is seeing a more stretched consumer. And we already know the reasons why. The Iran war has been pushing up gas prices and energy prices across the board, not just here in the U.S., but across the world as well. And people are choosing to go elsewhere instead of buying pets. They're buying pets or buying pet food. They're choosing to kind of stick to more affordable options. But that being said, he still is, again, expecting that things will remain resilient.
All right,
keep an eye out.
Let's get to DoorDash, which has a new competitor who has entered the delivery market.
Walmart, which is kind of a surprising one to me. DoorDash fell 4.9% into the close after a report from Business Insider saying that Walmart is planning to now allow its drivers, part of Walmart Spark, which is their delivery service, to deliver food from restaurants like McDonald's and also Dunkin' Donuts. That is kind of joining its competitors, whether it's be like Uber Eats or Grubhub. DoorDash has really been fighting to stay ahead of the competition. And worth noting, though, that this is only more specifically for orders placed at chains that are already housed within a Walmart. So this isn't all across the board in terms of all restaurants being able to get things delivered from Walmart Spark. But definitely something we're going to keep an eye on as well.
All right, Bloomberg's Avalon Purnell with the latest. Thanks for that. Coming up next, moving beyond GPUs in AI stock and what looks good in consumer staples. Back in a moment. NVIDIA reports earnings tomorrow. Many eyes on that. Investors keeping a close watch on what it means for AI stocks and what makes consumer staples attractive at this time. For more on investment ideas, let's go to David Dietz, Chief Investment Strategist, Dietz Wealth Management. Thanks for joining us today.
Good afternoon. Good to be with you.
So we know NVIDIA's earnings are always key. We look for the highlights. Sometimes at the end of last year, when they were reporting and doing great, investors didn't seem to care. But what are you looking for this time around?
Well, first of all, we're going to see how they've done in the quarter past. The expectations are just phenomenal. We're looking for revenues that are up 80% year over year. We're looking for earnings that are up 120% year over year. Those are totally off the chart compared to normal companies. We're looking for gross margins to be close to 75%. So the bar is very high. Having said that, if you look back for the last 12 quarters, NVIDIA keeps beating whatever those expectations are. So they better be in terms of keeping this market going.
We had Home Depot report today. It didn't do too badly, and it stuck to its forecast. I know others in the similar category are going to start reporting this week as well. What is your take so far on the health of the U.S. consumer?
So we did get some, I think, positive vibes coming out of Home Depot because, of course, Home Depot really is dependent on consumer sentiment. People don't remodel their homes. They don't do home renovation projects. They don't go out and splurge on those discretionary items unless they're feeling comfortable with the outlook for their jobs, feeling comfortable with the outlook for inflation, feeling comfortable with the outlook for interest rates. There's a lot to be worried about there. But sometimes actions speak louder than words. And indeed, the fact that Home Depot held up its forecast it had given before the Iranian conflict, I think, said a lot to me as to what they're seeing in terms of their stores going forward. And it was a real positive, and that's why the stock, the last time I checked, was up in a down tape.
Okay, so consumer staples is a sector you like right now. You also have a stock pick under the grocery chain called Albertsons. What makes this a stock pick for you? What do you like about it?
Yeah, so consumer staples have been left for dead, but there's going to come a day when people are going to prize those dividends, particularly if interest rates start coming down or there's some slowness in the economy. Consumer staples are a steady Eddie type of sector, paying good dividends, trading at valuations significantly below that of the overall market. So my pick in that area today is Albertsons. Now, this is a company that's coming off a failed terminated bid to buy it for, I think, close to $20 billion from Kroger. It did not pass muster, however, for antitrust reasons. However, they have, I think, done well and it showed me confidence in their business. How did they do that? They hiked the dividend 13%. They bought back a lot of stock. I'm seeing earnings that are going to be more than $2 a share for a stock that's down to about $16 a share. I like the fact that it's up today in a down tape, suggesting when the going gets tough for some of these high flyers, smart investors are looking for out of the way opportunities to offer those dividends. I think the stock is up 4%. It's a smaller player, but it's not so big. It's not so important how big you are across the country. It's how big you are in the particular regions you serve. If you're the number one in proximity to those consumers, you've got the cold position, and that's why I like the Alberts franchise.
Okay, let's talk about another stock you like, which is Accenture, and they do tech consulting. And I know there are a lot of concerns about consulting groups in tech, even in engineering, and those businesses being eaten out by AI. Why do you like Accenture?
So I think it's a couple things. One is the fact that the stock is down about 40% from its high. So a lot of the concerns and the worries that people are just going to be diverting their budgets from using the traditional consultants to finding AI plays or AI consultants and so forth, I think it's already in the stock. But beyond that, when you start looking at their business, they are rapidly deploying their consultants and their expertise to help companies tackle inserting and implementing AI into their businesses. So I think ultimately, instead of being kicked to the side of the road because of the AI movement, they're going to ultimately find themselves in the pole position to be an advisor. Now, this is a company, of course, which has a wonderful 10-year track record, very little debt. You've got a dividend close to 4%, and I can see that dividend increasing 10% per year going forward. So I think this is a super diamond in a rough that doesn't deserve to be there. Buy it with the stock being on sale today.
Okay, you also like Fiserv, which is down quite heavily this year. What do you see happening for them?
Yeah, so Fiserv has a much bigger discount. It's down 70% from its high, but it's a little trickier because they are undergoing a business transformation. They missed badly in earnings last summer. They brought in a new CEO, and now they're trying to stabilize the business. It's a very competitive situation. For example, their Clover offering is being undercut by other competitors. Having said that, again, this is a $56 stock. It should earn more than $7 a share. They have a decent dividend. And so I just think that they have to show the business is stabilizing and back on the upward track as one of the world's foremost payment processors to bring the growth investors back now that the value investors are already back in.
So, David, you believe the markets need a pause after the strong showing and comeback in the last month or two. But do you see that happening if earnings continue to be as strong as they have been so far?
So there's no question about it. Q1 earnings are just off the charts. And it's not just the earnings up 20%, which is far above expectations. You have revenues up 11% year over year. It's phenomenal. That's a Banana Republic type thing with hyperinflation to get revenues up 11% per year. Here's the problem. Next year at this time, the expectations that the hurdles will be that much higher because of how well they did this year. On top of that, of course, we do see interest rates moving higher. We do have the uncertainties of a new Fed chief. We don't know where commodities are going to settle out because we don't know when the Strait of Hormuz and the conflict in Iran is going to end. So there's a lot of uncertainties going forward. For the most part, I do believe that ultimately the inflation will be transitory because I think everyone on the planet, save for the Russians, want that strait to get open. And when those cargoes start flowing again, I do think there'll be a relaxation in the inflation concerns that will allow bond yields to come down. But nevertheless, ultimately, going forward, you're going to have to surpass these phenomenal earnings we're seeing right now.
David Dietz is Chief Investment Strategist, Dietz Wealth Management Group. Thanks for your time, David.
Thank you so much.
Straight ahead, Atkins Realis reported a Q1 revenue beat. We'll hear from the CEO in just a moment. Atkins Realis reported a beat in revenue, even with slumping growth in the U.S. and tensions in the Middle East. For more, we spoke to Ian Edwards, CEO of Atkins Realis.
Really good quarter. Very pleased with progress in both halves of the business. I mean, the global engineering services business actually grew 5% organically. We also concluded 3 deals in M&A in the quarter. And the nuclear business just keeps going from strength to strength. We had 37% growth in the quarter, and we're seeing wonderful opportunities going forward in our nuclear set.
I did want to ask you about that. Nuclear, obviously a major driver this quarter with strong revenue growth. How sustainable is that pace beyond 2026? Like, how much of this is kind of long-term energy security trends versus short-term projects that you're seeing?
Yeah, I mean, you know, we're all seeing this kind of energy crisis unfold, such that countries around the world are looking for energy security and long-term baseload power. We're also seeing the demand of AI really drive energy demands across the world, and the hyperscalers themselves are looking for their own solutions to provide for their data centers and AI factories. So nuclear is a real credible alternative now. I mean, I travel the world meeting energy ministers. I travel and have met this quarter a lot of hyperscalers. And it's a very, very exciting time for our specific technology, which is the Canadian indigenous technology, which has very, very many differentiating factors, you know, not least of which is the fact that we have a very capable nuclear business, an ecosystem in Canada that we can deploy to build capacity for the demand ahead. So I think it's a very sustainable situation of demand.
When you're talking about energy security and infrastructure, what do you see as the biggest driver for this? Is it the AI build-out or more geopolitical, as you were mentioning?
I think both. I mean, for sure, the AI build-out is stretching the grids, and the hyperscalers themselves are really looking for solutions. And, you know, we've been engaging those hyperscalers, and we're putting our technology through the licensing process in the US so that we can be ready and deploy for them. But what's been interesting revelation for me personally is that there's always a concern about nuclear in terms of how long does it take to build and get available power. But actually now gas is probably one of the biggest kind of favored technologies right now. It's suffering from big backlogs in manufacturing, and our technology now is becoming comparable from a time perspective. So that's a game changer. But also, most countries around the world are finding this renewable kind of move towards net zero and energy security a challenge. And 38 countries around the world have now signed up to the COP28 pledge to triple nuclear power. So you're seeing a lot of countries put nuclear into their policies, which is clearly great news for Atkins Realis and Canada as a whole because of our nuclear technology.
Backlog has now reached $20 billion. You are converting backlog into revenue. Is that conversion accelerating, or is it kind of taking longer given the complexity of some of these projects?
Well, I mean, we've been actually looking at record backlogs through many quarters last year, and obviously we've got a strong backlog now. There are opportunities on both sides, which are bringing new projects into the fold. We had a good Q1 of work winning. So So as our revenues are increasing and growing on both sides of the business in engineering services and nuclear, we're also winning as well. So we would see this continuing for the foreseeable future, for sure.
You've also been pretty active on acquisitions. What's the strategic goal here? Is this about growth, margins, or kind of reshaping the business?
Yeah, on the engineering services side of the business, we want to call out what we fill out the white space, so to speak, where we see good geographic opportunity for our capabilities. Australia has been a target because we're seeing good energy capability there, good energy opportunity, and we're seeing good defense opportunity. So we've actually announced 3 acquisitions in Australia to give us a platform for growth. But the US is definitely a priority for us. We see a very strong market there. We are probably playing at around about the number 15 player, and we want to be in the top 5. So we've acquired a couple of businesses there, and you'll see more coming through. Again, to build out our capability across the country, we can complement that with our nuclear technology, and we can acquire both transportation and energy and power projects across that country, which clearly, is a long-term sustainable market for ourselves.
And just lastly, you also returned capital to shareholders this quarter. I wonder how you balance that versus investing in growth and M&A activity as well.
Yeah, I mean, we take the opportunity. We've got a very strong balance sheet. We have strengthened that balance sheet over the previous years. We've got no debt. We're actually carrying negative leverage. So as we see fluctuations in the share price, we will buy back. But one of our priorities is still M&A for the long-term growth of the business. So it's a balance between both. Returns to shareholders and looking at the longer term for growth in the business.
Ian Edwards, the CEO of Atkins Realis. And Nissan considering exporting cars built at a joint venture with its Chinese partner to Canada, which is, of course, opening up the market to electric vehicles made in China. Let's go to Bloomberg's Detroit bureau chief, David Welch. He joins us now on this. David, thanks for your time. Look, several companies have expressed interest in selling Chinese-made EVs in this country, but the market's only open to 49,000. Does it make sense for Nissan to try and get in on this?
It would, especially if they're going to export the cars and not try to set up production in Canada, because that would be a bigger investment. But if they want to just see how interested the market is, see if the electric vehicles they make in China, which in some cases are smaller, would find buyers in Canada, it's a pretty good way to test the market. And then if they are popular and the Canadian government opens it up to greater sales volumes, then they've already got a foothold there, and they can push even more. So I think in terms of profit and that sort of thing, it's not going to be a huge moneymaker for them to start with, but it's a way for them to get in and get Canadian buyers interested in electric vehicles and start pushing the technology.
What kind of vehicle do they make? Where do they make it? What fits the criteria here?
So during the interview, the Nissan executives who were talking about this, they mentioned a couple vehicles for South America coming out of China. One is the N7, which is a sort of a crossover SUV, a midsize. That's all electric, and they have a pickup truck as well that's a plug-in hybrid. And they didn't say what they would export from China to Canada, but if you start to put 2 and 2 together and speculate a bit, either one of those vehicles could be it. I would suspect it would be the N7. That sells for about $20,000 in China. If you bring it up to safety standards for Canada and figure there have to be some cost exporting the vehicle from China to the Canadian market, it'd be more than that. But I still think you could probably get a vehicle that's $30,000 or less. And I'm talking US dollars, by the way, for Canadian consumers, given for what it sells for in China.
Okay, so we know BYD is a big player in China. They've shown interest in coming to Canada as well. Would the Nissan vehicles be competitive against a company like BYD?
It probably would, and Tesla has talked about selling a 40,000 Canadian, $30,000 US version of the Model 3. They're all sort of in the same size, same price range. BYD makes a very good product. And the challenge then is getting Canadians to figure out what the BYD brand is. But I think To start, Nissan might have to sell a little bit cheaper than that because BYD's got some very cool infotainment technology and some other things. But we'd have to see once everybody gets in the market and starts competing with each other for that very small 49,000 vehicle initial volume that the Canadian government's going to allow in.
All right, Bloomberg's David Welch with the latest there. Thanks for joining us. Appreciate it. You're watching The Close on BNN Bloomberg. We're back in a moment. Here are the stories making headlines right now. Higher energy prices drove Canada's inflation rate up to 2.8% in April, reaching its highest level in almost 2 years. The conflict in the Middle East continued to push up gasoline prices last month, which rose by almost 29% from a year before. While price growth reached its fastest pace since May 2024, it was still lower than the rate economists had been expecting. Agnico Eagle going ahead with a project in Canada's far north. The miner says it will build a large gold mine in Nunavut and plans to spend more than $2 billion on initial capital costs. The project has been hailed by the federal government as an anchor for economic development in the Arctic. Shares of Hive digital technology saw a surge today after Buzz HPC, a cloud and data center subsidiary of the crypto firm, announced plans to build an AI data center in Toronto. The 320 megawatt facility will create one of North America's largest domestically controlled AI clusters and is scheduled to go online in the second half of next year. The world's largest home improvement retailer is out with its quarterly earnings. Home Depot slightly beat on earnings per share and reaffirmed its 2026 guidance, but sales were slightly below estimates. We got perspective from Dan Rohinton, portfolio manager at IA Global Asset Management.
What's happened with Home Depot is you had such a huge surge in COVID, and you've had a hangover for a few years. And it's important to understand when it comes to this, high interest rates, they tend to take a bite out of transaction velocity of homes, Lindsay. Mm-hmm. And then with that, then you don't feel the urge to feel like you're getting a return on your remodel and repair. So that kind of slows down Home Depot's core business, and they don't really grow stores all that much, so they're very sensitive to the actual comparable store sales metric, which is 0.6. That's not enough to keep driving operating leverage in the business, so you saw gross margin come down a little bit, and you see operating margins under pressure because you have to make some offsets here and there. So is it a brutal quarter? No, but it's in the context of the valuation, which is pretty cheap because there's really a demand shortfall that we're trying to search for here.
And that's interesting, too, because I was looking at, it left its outlook unchanged for the year. We're getting into the time of year where people are going to Home Depot maybe a little more, renovations, getting their yards up and running for the summer. You're not surprised by the fact that they didn't change their outlook?
Yeah, because usually there's seasonality to Home Depot's business, so it's all true from prior years. So what investors like ourselves do is we look back to how was their Q1, how was their Q4, so we look at their prior stacked comps, as it's known. So that really tells you that there's 0 to 2% guidance for comparable store sales. It's just within the realm of what you would expect, and it's nothing all that special. And most analysts have it about 1.1, 1.2. So nothing great, but the stock's at relative lows, especially in a pretty strong market. So that's why you're not seeing a weaker result this morning.
Okay, nothing great, but nothing crazy either. I want to move on. There's another story that you want to talk about today, and that's Google and Blackstone, which have launched a massive new AI cloud business. What's so interesting to you about this? I mean, tell us more about what you know about what's going on here.
So this is in the context of the strongest month that the semiconductor index has had in the better part of 25, if not 30 years.
Wow.
So that usually, there's this idea that, these companies do extremely difficult science, and even the neoclouds, which are the competitors to your Microsoft Azures, your Google Cloud, and Amazon Web Services, these smaller upstarts are trying to nibble away at the big companies. And Google comes in with a joint venture with Blackstone saying, yeah, we're going to get into that business too on the low end. And really this strategy is private equity muscling into data centers in a bigger way where they're selling third-party compute. And Google is just the chip partner for that. I have a lot of questions about what this means over time for Google and how much silicon they really have to spare for their internal workloads. But there's a reason why a Nebius, a CoreWeave, an Iron, Applied Digital, all these stocks are under pressure here, because this tells you that the tail end of the capital stack is still open and capital is flooding into this space. And if I may lean on to this one step further, what you need to focus on from here for the next few years is that we are seeing a convergence in the US economy and many parts of the global economy under the AI theme. So what was historically a tech isolated cycle is now going into more conventional balance sheet centric areas. So if AI misses, the repercussions and the ripples will be far greater. And if AI is successful, the rewards will be more distributed as well across more sectors. So I'll stop there.
What is AI, when you say like if AI misses? Because no one really talks about that. Like what does that really mean? What does that look like?
Yeah, so AI missing, and I'll give a perfect example of it, is AI missed in the consumer landscape. And I know it's a crazy thing to say that almost 1 billion people use ChatGPT on a weekly basis. Sorry, monthly, I apologize. And that is considered a miss because the propensity for users to pay for the premium subscription just isn't there. So AI missed extremely lofty expectations in terms of how much consumers would adopt it, but enterprise, the businesses, are adopting it at a rapid pace. So if enterprise say, maybe this is too expensive, we're going to dial it back, we're going to slow it down, that downstream missing of the growth forecast then goes into, well, maybe we'll buy the chips a year later. Maybe we'll slow down the permitting of this data center. And suddenly all the power companies, the electrical companies, the semiconductor companies, that ripples all the way down. So missing doesn't mean that we're not going to grow adoption. It just means we're not growing it exponentially, which is where the current plans are.
Right, and there'd be quite a stall if that were to happen, as you say, like the trickle-down effect. Before we move on, like Blackstone's planned $25 billion investment in scaling up this AI cloud infrastructure. How significant is that to you, that investment? Like, what does that look like?
You know, the irony about it is it's very quaint in the context of everything else that's being built out. So it's only about 500 megawatts. There's other clusters that are being built that are several gigawatts. So to put it into, let's put it into Ottawa perspectives, because it's the last data point I have.
Right.
This is about like 1/8 of an Ottawa. There's bigger data centers that are basically the size of Ottawa in terms of how much their full demand is for the gigawatts that they're going to consume. But all that being said, it just tells you that this is the toehold and it could expand further and further and further. So it becomes a capital shootout game, which is just worse for investors in the neoclouds especially.
Interesting. Okay, moving on to another thing that you wanted to touch on today, and that is a federal jury throwing out Elon Musk's lawsuit against Sam Altman and OpenAI, basically saying that Elon Musk he should have filed sooner.
Basically.
What do you make of that?
It's one of those interesting things. There's a lot of palace intrigue in this AI race amongst the big labs, because you have a lot of people that have moved around. So OpenAI's founding team with Sam Altman and Greg Bachman don't get along with Anthropic's team. So we're talking about trillion-dollar companies where there's deep personal animosity between the investors. And Elon Musk is in the fray because he founded OpenAI with Sam Altman back in the day. So he lost it on the technicality, but he is probably going to refile. And these are all distractions going into probably the first of 3 trillion-dollar IPOs that are coming later in this year. So SpaceX is going to go first, but what's holding up OpenAI is this type of, call it palace intrigue that's going on between the old founder that got kicked out and so on and so forth. But what this also means is if you're investing hundreds of billions of dollars, because they did a $120 billion capital raise, that is OpenAI, you don't want a lawsuit saying the Series A at the seed stage was funded by a guy who got kicked out. Now he's suing to get XYZ% of the company. So this all throws gum in the wheels of a company that should be one of the marquee IPOs of our time.
What would that do, though? Like, is that just, it just sounds to me like that would just be bad PR. Is that more than that?
This settlement could be tens, if not $100 billion, if not more. So what the jury awards is such a huge unknown that if you're an investor buying the IPO, you don't know if you're going to get a 10% dilution, a 0, or a 20. And that's that type of thing where when you're in a capital-intensive business like AI, that's pretty impactful for dilution.
For sure. Okay, before we wrap up here, OpenAI, as you mentioned, eyeing an IPO later this year. Would you be a buy on that if that goes through?
Depending on the valuation, yes.
Why?
And I go back to, there's all the things I'm saying sounds really negative. Oh, there's a lot of capital being thrown into it. But these are some of the most productive uses of technology we've seen in a generation. So do I think that the technology is going to distill into society? I do. Do I think it's going to have rewards for society? I do. I have a very positive view of AI as we move further, while acknowledging there are negatives as well. So it comes down to if OpenAI's valuation is within the realm of sub 8 times revenue and lower, given the capital intensity of it, it doesn't deserve the same software multiple. Consider me interested. If it starts going into, crazy land, 20 times sales, 30 times sales, where you really have to believe in the really blue sky scenarios, I'm a little bit cautious. But it really depends the price, the valuation, and the revenue run rate at the time of the IPO. And we're in this exponential where if I'm wrong by one turn, it could really change the entry price. So I hesitate to say it, but that's my framework for thinking about it.
Dan Rohinton, IA Global Asset Management. Up next, shares of Matter got a boost. We sat down with the CEO. That conversation coming up next. Matter saw its shares jump last week after the company reported earnings that showed solid execution, and that helped to offset a typically slower start to the year. We got more from Mike Reeves, President, CEO of Matter.
We're seeing the market react to an inflection point in our business performance. Our Q1 beat and the improved full-year outlook really, I think, signals improving fundamentals, stronger execution as we emerge from a multi-year transformation. In the quarter itself, we saw strongly improved operational efficiency. We saw strength of sales into mining and North American transportation markets. And we continue to see a modestly favorable direction in the energy market, which I think will play out further as we roll through the year.
And the strength of sales, was that across the board?
It was particularly in the composite technology segment, where we are the North American market leader in the supply of underground fuel storage tanks to both retail fuel stations as well as to AI data centers and a number of other infrastructure projects.
Now, is that Xerxes? Is that
Xerxes is the brand name, and yes, that business has performed extremely well early in the year. Demand is at an all-time high. Backlog in that business is at an all-time high, and the execution within the business allowed Xerxes to deliver its strongest first quarter in history. So very proud of the team there, but they have a lot more they can accomplish.
And does that look? Yeah, I was going to say, does it look like that's going to carry on? And does that demand? Do you expect it to continue?
I think we continue to see that demand grow, and that's why we've invested in a brand new factory for that business, which came online last year and is ramping up production. So our expectations for that Xerxes business is that year over year, we can deliver 10% more tanks, and I am quite certain that we can sell every tank we can build. So that business, I think, is set for a multi-year growth and margin expansion journey.
So no worry about a bottle. You're thinking, do you have bottlenecks now, or you're just adding capacity?
We are just adding. We've worked very hard to localize our supply chains across the entire corporation and make certain that we limit the risk of exposure as we think about tariffs and other trade friction. And in Xerxes in particular, we are very well positioned. Supply of materials is free and clear of interruption. We have seen a little bit of an increase in costs for things like resins, which is largely a result of rising oil prices. But broadly speaking, we can pass those through to customers and maintain our margins.
And the tariffs, are tariffs not having too much of an impact?
They are not at the moment. I think at this point, we would say that tariff risk is probably abating across our organization. Everything we manufacture is USMCA or CUSMA compliant. We reconfigured our North American manufacturing footprint over the last 3 years to ensure that largely we manufacture where we sell. So we have a robust US footprint today and an appropriate Canadian footprint. So less and less of our products have to cross borders, which obviously keeps the risk on the tariff front as low as we can manage it.
All right. Now, FlexPipe, a bit of the other way. The volumes were off for it. What happened there?
So North America is our largest single market for the FlexPipe product. This is where we sell to oil and gas producers and allow them to move oil and natural gas from a newly completed well to their existing infrastructure. Total well completions in North America was lower by a little more than 10% in Q1 26 versus Q1 25. So that had some impact. But broadly speaking, after seeing about 4 years of lowering demand in the oil field space, we are confident that the beginning of 2026 represents a low point in the cycle. And from here, I expect to see onward and upward growth, both in terms of North American activity And in terms of share gain, we've invested very heavily in FlexPipe to expand our product portfolio, and now are in a position to really attack effectively the full breadth of the available market. And as we noted in our Q1 earnings call, post-quarter, we captured a meaningful international order for FlexPipe. That's the first time in about 2.5 years that we've seen really substantial international order activity. So I have a bullish view of both North American and international demand for FlexPipe products.
How big is that potential market, do you think?
So our largest competitor is approximately twice our size, and I have good confidence that we can approach their scale over the next 3 to 5 years.
All right, so ambitious. Let's talk a little bit about AmerCable, but it's a little over 16 months, I guess, closing in on 1.5 years. How are things coming together there?
So we acquired AmerCable early in January of 2025 and could not be happier. The team there have proven themselves to be incredibly talented. The performance of that business exceeded our expectation in calendar year 2025, and they've had a good solid start to 2026. Within that business, our largest single exposure is to the mining markets, both North America and international. We're very bullish on the demand for mining activity across a wide array of minerals and are well positioned to take advantage of that. So we are investing over the course of this year and next to bring additional productive capacity online in AmerCable, which I think will allow that business to not only deliver great margins, but also begin to grow at something closer to a double-digit percentage rate.
And is that tied in with, you had $104 million in operating cash flow in 2025? Is that where some of the money's going? Where else do you see that money going?
That's correct. So we've invested very heavily over the last 3 years. So what you'll see in 2026 is a more modest degree of capital spending, somewhere between $35 and $45 million. The largest single component of that will be investment in AmerCable.
And M&As, anything on the radar there?
So we've worked very hard to make sure we onboard the AmerCable acquisition and really extract full value from that activity. With most of that work now complete, I think we're back in the market to take a look at potential accretive, strategically aligned acquisitions. I'd say late this year is probably a realistic moment for that window to reopen.
Mike Reeves is president and CEO of Matter. Straight ahead, hot picks. We'll zero in on 3 software stocks for your portfolio when we come back. It's time for Hot Picks. We zeroed in on 3 plays in the software sector with Stephen Enders, Vice President and Senior Equity Research Analyst at Citi Research. And we kick things off with his outlook on the sector in general.
I think we're still trying to figure out exactly where things are heading and where things are trending. I think there's a lot of focus on what's happening with AI and the opportunities or the risks that kind of come from that and the disintermediation that could potentially come through. So I still think we're sort of figuring out where things are at. It kind of feels like maybe we found a bit of a new bottom here and maybe can feel a little bit more stable and support moving forward. But it always kind of feels like we're a headline away from the sentiment again kind of changing and reversing course. And I think that still kind of remains a bit of a risk right now for the entire sector.
Okay, so maybe on some wobbly ground. With that, though, let's get into your first top pick for today. This is what you say is the high-risk buy, Pegasystems Incorporated. Tell us more.
Yeah, so I think Pega has been one of those companies that maybe is a little bit of an underappreciated AI beneficiary across the landscape. I think you think about their roots; they're really good in automating workflows. And I think there's concerns in the market around what that means in an AI world if more of the decision is going to be put onto some of these model companies. Having said that, I think the kinds of workflows and the applications that Pega is really working on, I think are a little bit more kind of focused and centered in more complex kind of use cases where you have 100+ step processes and you have a lot of decisioning that kind of goes into it. And I think for the companies that they work with, it's a lot of regulated industries, a lot of banks, insurance companies, and the government. And I think the workflows that they tend to work on, I think are areas where there's probably more hesitancy to fully trust AI with those processes. I think it's one of those things you can plug in certain aspects of it into the workflow and some of those agentic capabilities as one part of the bigger process with Pega. And I think when you think about what they're doing with AI, they're really kind of putting into the forefront of their go-to-market and their product strategy, where it is helping them, I think, ease the on-ramp of their own product set and utilizing their blueprint strategy, which is their Gen AI strategy, to really simplify how customers are coming to them and utilizing Pega and getting out the gate in a more efficient way. So I do think there is more opportunities for them to drive growth. You've seen ACV accelerate, or their ARR accelerate, expecting to accelerate further going into the back part of this year. And so I do think that they are benefiting from Gen AI, but you still have all the concerns and risks that's weighing on sentiment for them.
Okay, next up, Appian Corporation. I'm not sure if I pronounced that right, but tell us more about this company.
Yeah, Appian, so they're kind of in the same space as Pega, where they are kind of like an application platform helping companies automate complex workflows. I think in a similar perspective with Pega, I think there's a lot of fears about disintermediation and what could happen if more of these application workflows end up becoming codified with agents or other AI systems. But at the same time, I think when you look at the types of workflows and the use cases that Appian is kind of playing in, it's a lot of things that are in highly regulated industries. 30% plus exposure into the federal government. They're winning larger contracts within the government space as well, including a $500 million ELA with the U.S. with the Army. And so I think there's a lot of those kind of initiatives that are still kind of going on. You think about what's happened with the DOGE and government efficiency over the past year and a half. I think Appian is a company that stands to benefit from that. I think you're starting to see that in the numbers. We're seeing cloud growth accelerate, and you're seeing revenue pick up as well. And AI is a big piece of that. I think they just disclosed that they have $100 million of ARR coming from their AI tier. They're seeing really good adoption. I think 1,000+% growth in some of the AI usage this past quarter. And so there's a lot of things that I think are going right there that are still underappreciated, because you do have that kind of longer term concerns if they could potentially be taken over by AI. But I don't think we're seeing that. I think if you look at the fundamentals, things are still really healthy right now for Appian.
Last topic was Box Incorporated, which you say looks like it could have some substantial growth by the end of this year.
Yeah, so I think that's another name where I think we see AI actually helping them accelerate, and I don't think people are fully kind of appreciating the opportunity that comes with it. They've really leaned into their enterprise suites opportunity over the past few years. The newest tier, which has only been out for about a year or so now, is already about 10% of revenue. Still only kind of mid-single digit penetrated across the customer base. I think if you think about what that means, if you kind of get that tier across the rest of the customer base, that's a 30 to 40% kind of uplift. I think they're at 70% plus penetration of suites already. I think that's an area where there's more that they can do. And I do think, again, you're kind of seeing an acceleration should continue. And I think you look at their agent strategy and what they're doing with AI. I think that there's a lot that they're doing on kind of the forefront, the cutting edge of technology, and integrating with all the major model vendors. I think they're working really well with the Anthropics and the OpenAIs and trying to be a big part of that content strategy moving forward for organizations. So I think we feel pretty good about the fundamentals on Box. Think that what they're doing is still pretty underappreciated, and think that you think about the disintermediation risk with AI. I think that there's a lot around the content side that is harder to replicate when you think about the security and the governance and the actual file capabilities there. So feel good about what's happening with Box right now and the long-term strategy here.
Stephen Enders, Vice President, Senior Equity Research Analyst, Citi Research. A final look at the markets before we end the show. The TSX Composite down 92 points, or about 1/3%. The S&P down 0.7, and the Nasdaq a 220-point drop on the day, down 0.8%. That does it for the close. Thanks very much for joining us. We'll see you back here tomorrow.